Hey, this is Jason from jasoninvesting.com. Hello, and a warm welcome to all of you. I'm the founder and instructor of Jason Investing, and with the help of my co-founder Andre and Kenneth, we are very happy to introduce you to our basic option trading strategies with S&P 500. It is truly a privilege to have you join us on this educational journey. Please remember to turn on the captions if you have trouble hearing the audio. So, let's start by first talking about what this course is about. This course is designed to demystify the world of options trading by giving you an intuitive and deep understanding of basic options strategies. We first start with the basics, such as key concepts and terminologies, and from there, we will then dive into basic option strategies, such as spreads, straddles, and many others. To give a brief introduction of options, options is a derivative, which means that it is derived from an underlying security. For this course, we'll focus only on SPY ETF and SPY options. SPY is the S&P 500 ETF. We will then employ option strategies that complement the portfolio, consisting of buying SPY shares and then using SPY options for leverage and risk management. All this will be clearer as we move along. Also, I would like to talk about our Jason Investing Weekly Investment Overview newsletter. A key part of this course is that you are able to follow what is in our newsletter. Our newsletter is catered to investors working on adopting a dollar cost averaging strategy. So we would assume that the subscriber would like to save a portion of their salary, and you can think of it in terms of like mortgage payment. So rather than pay a mortgage to buy a house, you would like to save that portion of money and invest it in the market instead. Part of the reason why there's this perception that people make money from property is partly because mortgage payments are kind of like a mandatory forced savings onto the buyer. Because if you're not forced to pay your mortgage, you might splurge it on something or you just gamble it away. So in a way, we can view our dollar cost averaging like mortgage payment, but we would then have to have our own discipline to save the money to ensure the discipline to dollar cost average. This also means that we put in a fixed amount and we always buy at whatever the market price is, which means that if the market is low, you will tend to buy more, in our case, buy shares, and when the market is high, you tend to buy less. A special part of our newsletter is that we incorporate options into our portfolio. The way I like to see this is it's akin to buying a lottery in order to make exceptional returns. The definition of a lottery is that you pay a small amount for the lottery ticket and for the hope of potentially striking the lottery. In our case, the lottery ticket is similar to our options premium, but the odds of us striking a decent return is definitely higher in a lottery because the chances of you winning a lottery is close to zero. But the analogy here is such that the case that you will only lose a small amount of money, which is like the price of a lottery ticket, but you are able to potentially strike a windfall. In our case, because the odds are not so low, the winnings are not that exceptional as well. So we would like to try to balance out and make a decent return. For our newsletter, we will give out a weekly trade notification that we will send out on a Sunday and to be executed by the subscriber on a Monday. Because our option strategies are relatively risk averse, we do not actively time the market in such a way that you will have to execute the trade definitely on a Monday. Because we are not able to see or predict the market in the short term, at least without any significant confidence, the price that you trade shouldn't be that time sensitive because we are focusing on the long run, but we will still prefer that the subscriber is able to trade at the same time as us, which in most cases will be on the first trading day of the week. And if not, the difference would be, okay, let's say for example, we give the notification on a Sunday to be executed on a Monday. And if the subscriber, for some reason, forgets to trade on a Monday, but they can always trade on a Tuesday or Wednesday. The only difference will be that the price they trade will be different from the one that we trade in our paper account. So we open an interactive broker, IBKR, paper trading account, in order to keep track and mimic how a typical subscriber will trade in the market. It will be entirely based on our trade notifications, and that we will be able to monitor and also generate report directly from IBKR, so the subscriber could see how well we do, and also based on our actual market price, which in IBKR paper trading account also includes the commission. This will make it a lot more real in terms of assessing our performance. Also, in our weekly newsletter, we will do a weekly portfolio review and market recap, so that you can know what's happening in the market and what happened in the market and how it affected our portfolio for the week. So, to subscribe, go to www.jasoninvesting.com and click subscribe now. Next, let me tell you a little bit about myself. My name is Jason, as you probably already know, and I've been involved in options trading for a number of years now. And I've always been interested in financial and quantitative stuff. My background is I'm a computer science and math major, and I started off as a software/web developer. So basically, I can code my own models and do my own data analysis. And because I'm interested in the market, I read up a lot on that on my own. I also did quite a bit of economics courses back in university. So over the years, I started trading options on my own. I realized because option is by nature non-linear, so it is not so straightforward and simple like normal trading. For example, if you buy SPY shares, and if the market goes up $1, you make $1. If it goes down $1, you lose $1. Or there are a lot of trading strategies out there. When you buy, when you see a certain pattern, or you sell when you see, for example, a head or shoulder pattern. Let's put it this way. It's like an either-or situation. You either have to buy or you have to sell. But this is where options come into play, where you can have more room for uncertainty, in the sense that you don't really have to make the call, do I have to buy or do I have to sell? This will become clearer as we move along in the course. Also, I would like to talk about our Jason Investing Weekly Investment Overview newsletter. A key part of this course is that you are able to follow what is in our newsletter. Our newsletter is catered to investors working on adopting a dollar cost averaging strategy. So we would assume that the subscriber would like to save a portion of their salary. And you can think of it in terms of like mortgage payment. So rather than, pay a mortgage to buy a house, you would like to save that portion of money and invest it in the market instead. Part of the reason why there's this perception that people make money from property is partly because mortgage payments are kind of like a mandatory forced savings onto the buyer. Because if you're not forced to pay your mortgage, you might splurge it on something or you just gamble it away. So in a way, we can view our dollar cost averaging like mortgage payment, but we would then have to have our own discipline to save the money to ensure the discipline to dollar cost average. This also means that we put in the fixed amount and we always buy at whatever the market price is, which means that if the market is low, you will tend to buy more, in our case, buy shares, and when the market is high, you tend to buy less. Let's put it this way. It's like an either-or situation. You either have to buy or you have to sell. But this is where options come into play, where you can have more room for uncertainty, in the sense that you don't really have to make the call, do I have to buy or do I have to sell? This will become clearer as we move along in the course. For my own personal experience, I've gone through high and lows in the market. I've made like huge profits, and at the same time, I have frightening losses as well. So I feel like I've seen a lot. And because, especially from losses you make, you actually learn to be respectful of the fact that the market can potentially move against you, especially when options come into play because leverage is involved. So you need to be careful with that, but there's really no way for you to learn without actually really burning yourself, so to speak. So yeah, this is something that I keep in mind, and because of that, I came up with specific strategy for option leverage, but with very careful risk assessment when we dabble with options. For example, there's no naked options, so basically everything is hedged. So what's the meaning of naked option? We will cover that in due course. This also means that from the get-go, we would know what is the maximum loss for each options position we have. This is very important because you could have potentially large losses if you do not have a careful risk management. In 2019, I've earned my CFA charter. The interesting thing about my CFA journey is I actually did my CFA exams in 3 different cities. The first one I did in Vancouver, and level 2 I did in Singapore, and my final level I did it in Shanghai. So it's interesting in the sense that I get to see different test centers. The journey to obtaining CFA is challenging and time consuming, but at the same time you get to learn a lot of stuff. But the problem is there's so much stuff crammed into the syllabus that you don't really get to fully understand or appreciate what you have learned, because your focus at that time was just probably to pass the exam, because if you fail you will have to wait for another year. But now that I have passed all 3 exams and having quite a bit of experience working in the financial industry, now I go back and I reflect on these subjects. They make a lot more sense. So my plan is also in the future to be able to contribute more courses that touch on different aspects of the CFA syllabus, which I think would be very interesting. And as I said, my background is in computer science, so in the course and also in the newsletter, you'll see a lot of charts that are generated via R. So I do a lot of this coding and also quantitative analysis kind of coding. After I started trading on my own, I start building a statistical model and able to generate my own dashboard to monitor my trading. And now for this course, I'm able to use that to effectively try to convey and teach you guys how to master, at least for this course, the basic option strategies. So with the introduction done, let's dive into lesson 1.1, understanding option. In this lesson, we will lay the groundwork for what will become a comprehensive skill set trading options. You will learn the basic terminology and mechanics of option trading, including roles of calls and puts. We will address the benefits that options can offer, such as leverage and risk management, while also addressing the risk and loss and how to approach them. Moreover, we will introduce SPY ETF for its liquidity and market representation. This lesson is your first step towards becoming proficient in options trading and set the stage for more advanced strategies and insights to come. What are options? In essence, an option is a financial derivative that gives you the right but not the obligation to buy or sell an underlying asset at a predetermined price known as the strike price within a specific time frame. But what does that mean exactly? One good analogy would be you want to buy a used car, but you do not want to make the decision now, and you want to reserve the right to buy it at a price that's fixed now in the future. What the dealer would do is to sell you a call option so that you're able to buy the car within a specific period at an agreed upon price at the get-go. Given this choice, this option should be worth something, right? You have to pay to reserve the right to buy the used car. If not, no dealer will want to give this option for free. So this is an example of a call option. Similarly, for a put option, an analogy for that will be that you want to sell a car to a dealer, but you don't want to sell it now, but you want to reserve the right to sell in the future at a price fixed now. And if the price of the used car fall over a period of time, you're still able to sell the car at agreed upon price. The agreed upon price will be the strike price, and because the dealer, you would have to pay a premium to the dealer to be able to lock in the price. And for that period of time, that will be the premium for the option. Of course, if the used car market actually goes up above the strike price, you could actually sell the car in the market for a higher price than the strike price. So there will be really no reason why you want to sell it at the strike price that you agreed on. So that's the part where we refer that it's not an obligation, because if it's an obligation, you would have to pay or sell at the agreed upon price. So the premium is a way for you to afford this choice, whether you want to exercise the option or not. So one example where you do have the obligation to buy or sell at agreed price would be a futures contract. But you would think, is that such a good thing that you can have the right but not the obligation? The whole reason why you have the choice is because you're paying a premium for it. The premium is a way for you to compensate the seller for taking the risk of giving you the option, because from the seller's perspective, the market price would change, right? And if the price were to go against the seller, for example, if you were to buy a put option, you're protecting yourself from the downside. But if the market were to go down and you still have to sell to the dealer at a higher price, the dealer will need to buy from you at a higher price, right? So the reason why the dealer is willing to take the risk because you're paying a premium for him. And if the market were to go up, then the dealer would just pocket the premium. So there's always a cost that's involved if you were to long an option, but there's actually a way to reduce this cost, and that is by employing certain strategies that we will cover in the future, because sometimes the cost can be exorbitant, and in order for us to reduce the cost, remember in finance there's no such thing as a free lunch. By reducing the cost, you would also have to sacrifice the upside. Anyway, we shall cover this in the future. Let's now look at the payoff diagrams for the long call and long put option. If you're looking at the chart right now, on the left we have the long call and on the right we have the long put. Both options have 505 as the strike price. We have more to say about them in later slides. So let us go through the exact definition of a call option. Call option grants investors the right to purchase the underlying asset at a specific strike price until the option expiration date. This is basically the same definition I gave earlier for the used car example. So a long call is ideal for bullish investors buying a call option to speculate that the asset price will rise above the strike price before the option expires, aiming for a significant profit on a relatively small investment. This part about relatively small investment means that you pay a relatively small amount of premium and you're able to potentially make a significant profit if the market actually went up a lot. But it's kind of misleading because there are in fact many strike prices to choose from. So not all strike price would be relatively small investment. This we will cover in the future when we learn about the moneyness of an option and delta as well. So they give you a preview. So if the option is out of the money, it tends to be cheap. But if it's in the money, it's no longer cheap. So this relatively small investment is conditional on the moneyness of the option. And also, if you have some experience in options, you must have heard people talk about implied volatility or IV. So if the IV is low, the option is cheap, and the IV is high. If the IV is high, option is expensive. But this talk about IV is also kind of misleading as well, because IV is only one factor to explain the price of an option. Delta is another factor. So you cannot just look at one and not the other. Next, we look at the call options payoff diagram. If looking at the chart right now on the slide, we first explain what's on the y-axis. The y-axis is the payoff, which essentially is the P&L, the profit and loss, and the x-axis is underlying price. In this case, would be SPY price. The blue line is the payoff of the call option, the hockey stick line, and the green line is the payoff of the underlying. So let's first explain the payoff of the underlying, because it's very simple. It's just a linear straight line with a certain slope. The slope is actually 1. So it means that with every dollar increase in the underlying SPY price, the payoff will go up by $1. Similarly, if the price were to go down by $1, you will lose $1 as well. Whereas for the blue line is the payoff of a call option. This is the part where I kept repeating earlier about the non-linear nature of option. So this is the case. The payoff is not a linear line. But this blue line is also quite misleading, because the payoff only looks like this on expiration date, and prior to expiration date it doesn't actually look like this. In future lesson, when we talk about delta, I will show you how the payoff actually looks like prior to expiration. It's going to be a continuous smooth curve rather than a hockey stick with a sharp corner. And talking about a sharp corner, that sharp corner is coincide with the strike price. In this case, the strike price is 505. So what it's saying is if the underlying closes above the strike price, you will start making money, in the sense that if you look at the slope of the blue line above 505, it's the same as the green line, which is 1. And below the strike price, basically is a flat line, and that will be the loss. And how much loss are we talking about? The loss will be the cost of the premium. In this example, we just use $20. So basically it's minus 20 for the payoff. And anything above 505, you start making money. But you notice that we have this break-even zero line, graded dash line. So the zero line is basically the break-even point where you neither make or lose money. So you'll be asking, okay, you said that you start making money at 505 and above, but that is below the gray zero line, right? So what's going on here? The reason is because, remember, you paid upfront the $20 premium, so you would have to make $20 just to break even. So in all, the break-even point will be precisely 505 plus 20. The point will be 525. So above 525, you will start making money. And another thing to note is, if you notice that the green line, the underlying payoff, seems to be above the blue line most of the time, right? Like, if you were to look from 485 and above, the green line is above the blue line. So this is saying that if the underlying were to close above 485, basically the underlying will make more money at a constant. If you see the difference is actually a constant gap. The difference is actually the premium, which is $20, right? So how do I get 485? It's basically 505 minus 20. So the point where they meet is at 485. But notice that below 485, while your losses is capped at minus 20, the losses is potentially will go down to 0, because the underlying SPY could go all the way down to 0, although it's very unlikely, and then your P&L will go down accordingly. So because remember I said that because of the fact that you're paying a premium for this, that's why you exercise, you enjoy the luxury of capping your loss, right? So that capping the loss part is basically the right for you to buy the underlying at the price that is agreed upon. So the price that is agreed upon is 505, and that somehow cap your losses. And how does it do it? Okay, so if you think about this, so what the definition of the call option, as we have seen earlier, is trying to say is that if, for example, if SPY were to close, say, at 550, right? At 550, so you have the right to buy the underlying, which is SPY ETF, at 505, right? So essentially, what you could do is you can buy at 505 and immediately sell it at 550, right? That would be the market price at the expiration close. So the difference would be actually the profit. So 550 minus 505, that comes up to $45, right? That would be the profit. In actual fact, if you take the P&L and you subtract the point, I mean, if you look at the P&L when it's at 550, it should be around 45. It's not, because you still have to factor in the $20 premium, so your profit is actually 25. That's how we can calculate the P&L. But if, let's say, it falls to 450, right? You have the right to buy at 505, but remember, it's a right, not an obligation. So you can choose to not do anything. So what you will lose is just the premium, which is $20. So now we come to put options. Put option allows the holder to sell an underlying asset at the strike price until the option expires. They are utilized when expecting the price of an asset to decline. So remember the used car analogy that I said earlier, that you want to sell a car and you want to fix the price. So if the market price were to drop, you can still sell the car at the agreed upon price, which is higher than the market price. So this sort of help you to offset the decline. Okay, now let's look at the payoff diagram. Okay, similar to the call options payoff diagram, you can see that we have this green and blue line as well, but now we have it in a different direction. Previously, we see that the green underlying increased from the left to the right, but now we have this green underlying increasing from the right to the left. The underlying is no longer a long underlying, where it is actually a short underlying. So what does this mean exactly? It means that you are shorting the SPY shares. So if you have no idea what a short position is, it means that you in this specific example, you borrow, say, SPY shares from the broker, and you just sell it in the market. But because you still owe the shares to the broker, right? So you will have to eventually buy it back. The idea is, if you can sell it at a higher price and buy it back at a lower price, you will have made money, right? But the thing is, it goes both ways as well. If the market keeps on increasing rather than dropping, you will have to buy it back at a higher price, right? And the convention wisdom is shorting is very risky than longing the underlying. The reason is because when you long an underlying, your maximum loss will be if the underlying goes down to zero. Whereas for shorting the underlying, your losses could be unlimited. Like it can go to infinity, but of course, no stocks or index is going to go to infinity, right? But theoretically, your losses could be infinity. So in that sense, shorting something is considered a lot riskier than longing the underlying. So because the green line now represent a short position, so we have this slope, right? It's actually a negative slope, and the payoff of the option is the blue line. So let's revisit the same thought process as the call option. 505 would be the strike price for the put. So if the underlying to close below 505, you start making money, right? Same idea as the call option. But you still have this break-even part because of the fact that you still have this $20 premium. So 505 minus 20 will be 485. So you break even at 485. And note that the slope of the option payoff is the same as the underlying, which is 1, which means that every decrease in every dollar decrease in the underlying, your P&L will go up by $1. And similarly, the reverse is true as well. And the fact that the green line is always a constant $20 above the blue line until the part where it's 505 plus 20, 525. That will be the part where that will no longer be the case. And the reason for that is because of the $20 premium that you paid. You would have to make an additional $20 just to break even. But because of the premium, you have your losses will be capped. Whereas for the underlying, the losses is it goes down to potentially minus infinity. And also you need to understand how this relates to the definition of a put option. So the put option gives you the right to sell an underlying at a specific agreed upon price, right? So in this case it's 505. So what this is telling you is that you can sell at 505 even though the market drops. So for example, we take an example 450. So say if SPY were to close at 450 and you're able to sell at 505, basically you have made a $55 premium, right? But because you still have to factor in the $20 premium, so your profit will be 35. And like the call option, if the underlying actually went up to above 505, and since you don't have the obligation to sell it at 505, you just not do anything, right? The option will just expire worthless, and your loss will be capped at minus 20. The key component of options are determined by four main components, namely the strike price, expiration date, premium, and the underlying asset. So two of the components, strike price and expiration date, affects the premium as well. And one thing that is missing from this is the implied volatility, which is also a key component of the options. But for now, let's just talk about these four components. If you look at the option chain, you can see these components in there. So let's first talk about the expiration date. If you look at the top left corner of the option chain where you see multiple tabs, so the different tabs are the expiration date. The one that is currently selected, May 17th 2024, that is the expiration date of the option chain. And IBKR also shows the number of days to expiration. In this case, the option has 47 days before it expires. If you look at the blue column in the middle, that will be the strike price. You have to be familiar with how a conventional option table is being displayed. The strike price is always increments from the top to the bottom. So if you see the first column, the first row is 515, and you just keep going down, right, until you see 560. In actual fact, that this is only a truncated view of the option chain. You can still scroll further up and further down. Okay, next is the premium. So where can you find the premium in the option chain? The premium is the bid and the ask price. So if you were buying, then you have to pay the higher ask price, and if you're selling option, you will be selling at the bid price. So the price of an option is dependent on the strike price. Remember, I was saying about the relatively cheap part about the strategy earlier on. So the cheap part is only applicable if we're talking about option that is out of the money. You might not truly appreciate what that means for now, but just looking at the option chain, you can see that before that, very important thing that I missed out. So on the left side of the option chain is for are the call options, and the right side the put options. Okay, so the conventional way to display is left side call, right side put, strike price increment from top to bottom. Okay, so let's look at the call option. If you notice the bid-ask spread, the bid-ask column, which is the first column, you can see that the call option gets more expensive as the strike price goes down, right? So the relatively cheap premium are the one that I'm talking about are at the lower half of the option chain, the cheaper options. So as you can see, not all options are cheap. The ones at the top are really expensive. You appreciate that in the future lessons. But for now, let me show you how to see the value of call option. We take the interesting 0.5 delta call. If you look at the 527, is somewhere in the middle. The 527 strike price. That is what we call at the money call option with a delta value of 0.5. Say you want to buy this call option, right? If you want to pay the highest price, which is the asking price, $8.97, $8.97, that would be the price of the call option. But it doesn't cost you $8.97. It actually costs you $897 for one contract, one options contract. Because the multiplier for SPY is 100, that means one option contract can you are able to convert or exercise or be assigned 100 shares. So you have to multiply that by 100. So in order to buy this option, you have to pay 897 US dollar. It doesn't look very cheap, right? But if you were to look down, let's find the cheapest one on display right now, which is 560. So 560, you're able to buy one contract at 49 US dollar. So you can see this is relatively cheap compared to the $897. As for the puts, it is actually kind of reverse. So now the option gets more expensive as the strike price goes higher, and it gets cheaper as the strike price goes lower. So the reason is because it's totally the other way around. Okay, let me see what is an intuitive way to understand this. Remember, the strike price is is the agreed upon price that you can buy or sell and the underlying asset, right? So for the call option, let's say the lower the strike price, that means you can buy at a lower price than the market price. So if the market would close at a higher price, a lower strike price will be worth a lot more money, right? Yeah, so that is the intuitive understanding of this. As for the puts, because you want to sell the underlying at the strike price, if the strike price is very low, you'll be selling at a lower price, which explains why it's cheaper. But if you can sell the underlying at a higher price, especially when the market is fell to a lower price, that option will be worth a lot more money. And you might think, okay, so how much is the underlying right now if I'm looking at this option chain, right? How much is the underlying? I cannot know for sure because I will have to check when I took this screenshot, but you can roughly see by looking at the delta of the option. So 0.5 delta would be roughly where the market is trading. If you look at the call option, 0.5 is about 527, but if you look at the put, the delta is actually at 526 if it's 0.5. So we can be reasonably sure that the price of the underlying at the time when I took the screenshot is about 526 to 527. The reason why the delta is not the same between the call and the put is because of interest rate. Don't want to confuse you, complicate that for now, but just take it that 0.5 is somewhere where the current underlying price is trading at. Types of option traders. As you know, as I just described, option markets are diverse. You can pursue different strategies. Different people have different market outlook and also investment goals. There are income seekers who often sell options to earn premium income. So far, the payoff diagram that we described are all long options, be it long call or long put. We haven't actually covered short position yet. For option contract, there's always a buy side, there's always a sell side. So there's always a counterparty to your contract. So, for example, if you were to long a call option, somebody will have to sell you that call option. So they will have to take the other side. For example, if you long an option, you pay the premium, right? Remember that to enjoy the luxury of having that right, and not the obligation, you will need to compensate the seller for the risk. And a lot of option traders prefer to sell option just to collect the premium. But you have to understand that this is a very risky venture, because if the market were to turn against you, so for example, if you're selling a call, if the market were to keep going higher, then you would have a unlimited loss, and vice versa. If you are selling a put and the market keep on falling, you would also have huge losses. But remember, I was saying that at most the market will drop to zero, so your losses will not be as astronomical as a seller of a call option. All this buying and selling is assuming that you are not hedged. In most cases, and especially for our strategy, we are always hedged. So we will never sell an option without buying an option to hedge the potential of the market turning against you. So don't think that whenever you buy when you long option, somebody is actually selling you a naked option. That is not true, because that person might be selling an option as part of a spread, and so it's not really right to think that all the counterparty is always a naked seller. And if you were to long a call option, most of the time, the idea is to bet on market movement. So, for example, if you're a long call, you're betting that the market will go up, and if you're long put, you're betting the market will go down, right? But also, hedgers use option to protect their investment portfolio from downside risk. So the thing is, they actually hold the underlying, and they are worried that the market go down and their portfolio will lose money, so they tend to buy insurance via put options. But as you know, nothing is free. That hedge involve a cost, and most of the time the cost is exorbitant. So if you constantly buy put options, you would constantly lose money. You might be rewarded when when the market tanks, but most of the time you will have to accept the fact that you're losing money. But all these are very simple, plain vanilla strategy, and most options trading don't actually do that. We will cover in future lessons when we talk about other strategies such as spreads that they involve both a long and a call. Both a long and a short position. So that will kind of offset the cost of your option. We'll touch on that more in the future. We have come to a rather important but also rather boring subject, which is the exercising of an option. There are two types of options: American and European option. For European option, you can only exercise the option at the end at expiration, and for American option, you can exercise anytime uh, before and on expiration date. So what do you mean by exercising an option? So if let's say for a call option, remember the 505 strike price. If buy underlying were to go above 505, that means you can buy at 505, right? So that means that if you were to exercise the option, let's say for European option on expiration date, you can buy at 505. What the brokerage account will do is that they will uh, they would deduct 505 cash from your account, and will just give you the 100 shares. So 505 multiplied by 100 will be 5,005, right? $5,050. So that will give you, by deducting that in cash, you will have 100 shares. And the idea is if the value of the share is much higher than 505, you can immediately sell it. So on paper, you have already made the profit. So the exercising part is equivalent to converting it into a equivalent amount of shares. So one SPY contract would be exercised to 100 shares. So for American option, you can choose to exercise the option anytime prior to expiration, right? So so that for our situation, we will never choose to exercise early. So if you don't want to think about this, we don't actually have to think about it. But there are scenarios where it might be advantageous for you to exercise an option, so to buy the underlying, just to collect the dividend. But in most cases, it's not really it doesn't really make a difference, because there is a time value for an option. I don't want to confuse you now, but by exercising the option, you are sacrificing the remaining time value. So in most cases, it's not optimal for people to exercise early. But because given a choice, because you have a choice to exercise early, so an American option would cost more than a European option. Another thing that I want to talk about is assignment. So when you exercise an option, on the other side, somebody would have to sell you the underlying shares, right? So for a call option, when you exercise, somebody will sell you the shares, and you would buy at the strike price. For a put option, you would have to sell, so somebody will have to buy the shares from you at the strike price. From the counterparty perspective, it's called an assignment. They will be assigned. The way IBKR works is that interactive brokers is that they will randomly choose somebody for assignment. So for example, if you sell a call option, you might be assigned early. If somebody choose to exercise early, so you would have to sell the shares to somebody if you are being assigned. But if by expiration, it will be automatically you will need to sell for sure. And also for exercising options, IBKR will also automatic exercise for you if your options is in the money. So for example, say on expiration, you have a call option and the underlying went up, so you're making money, right? But what happens if you might be worried, oh, I forgot to exercise my option, oh no, what's gonna happen to me? Oh, don't you worry, because IBK will automatically automatically exercise all options that are in the money. Real world application. This is one example where you buy a call option prior to an earnings announcement. In this case, this will be an individual stock option, as SPY index doesn't have any earnings report. For example, let's take Tesla for example. The earnings report comes out, sold a lot more cars than expected, and the stock price rocket. So if you want to buy the call option, you leverage, you make a lot of money. So this is like a simple example that is shown here. But in reality, life is not so simple, because the thing is, in most cases, the only time that you have a situation like this is when the earnings report that came out is different from the one that the market expects. There's always this thing about expectation that we always talk about, even in economics. And why do we care so much about this market expectation? Because in stock market, everything is forward looking. Everything is about future expectation. And the market is like the average, the aggregate or the average of everybody's view. In other words, wisdom of the crowd. To summarize, it's an average of everybody's view about what's going to happen in the future, and you discount it back, and that will be the current price of the stock price. And this discounting it back as it involves the interest rate and the time value of money. This is a very interesting topic, but this will probably we will talk about it in another course. So if everybody thinks that the earnings is going to come out positive, this would have already been factored to the price, and also factor into the options price as well. So you wouldn't actually make any exceptional returns from this. For example, Tesla stock price, if everybody thinks that the earnings is going to come out very positive, it would have been factored into the stock price, which means that the stock price would have already risen, right? But when it comes to options, it's a little bit different. Let's imagine that the earnings is highly uncertain. The market doesn't know whether it's going to come out positive or whether it's going to come out negative. So in this case, you can imagine that the stock price would not move prior to the earnings report, because it doesn't know what to do. But for the options, the implied volatility will rocket, right? Which means that the options will be very expensive, because we do not know what is going to happen, right? It can move either way. So if you were to think of buying the call option prior to the earnings announcement, then you will have bought the option at a very expensive price, and the market will have to move a lot upwards in order for you to make exceptional returns. And most of the time, if the earning comes out to be nothing spectacular, then the implied volatility will drop rapidly after the market announced, and straight from the get-go, you will have suffered a loss from the drop in the implied volatility. It is something like you buying insurance just before the hurricane approach. Just imagine the hurricane, approaching from far, and you can see the hurricane, and you go down to the insurance company and say, I want to buy insurance for my house. The insurance company will say, sure, but you will have to pay this sky high premium. The only way this would work out for you is there is no expectation of any hurricane. You go buy an insurance policy for cheap, and then the next day, wow, the hurricane came, and then you will have a huge payoff. So it's a similar idea. In today's session, we cover the basics of options, including their types, key components, strategic uses, and profile of typical option traders. Remember, the use of options in your investment strategies rely on understanding these fundamentals and applying them according to your financial goals and risk tolerance. I kept emphasizing that the risk assessment is highly important. Even there is a high probability of making decent money, but in the event of a black swan event, you might lose all of them. So even though you make money regularly, but one day black swan happen, lose everything. So we don't want that. So in our strategy, we would avoid that happening as much as possible. And also, different people, they have different financial goals. But for our course and also our newsletter, we target a specific subset of the population, which are people who earn a salary and would like to save a portion of the salary and invest in the market for the long term with a reasonable risk profile. The stress, we need to stress that it is for the long term. So in cases like this, we will target specifically for that to simplify our discussion for today and for future lessons. Alright, we come to the end of today's lesson. If you have any question, feel free to leave a comment on the video below, or you can email us at hello@jasoninvesting.com. Alright, thanks for attending the lesson and have a good day. Bye.